The retail recession has arrived. The Warehouse Group unveils the impact of the cost of living crisis.
It's clear that our customers have had a tough year and we've had a tough year alongside them. This recession has been looming for some time.
It's Friday the 29th of September and you're watching Markets with Madison. It's been called one of the worst stocks in the retail ranks by analysts. The Warehouse Group just reported a 65.6% fall in net profit. On the surface, sales actually looked quite good at $3.4 billion, but inflation is eating away at earnings. The increased cost of wages and crime prevention measures is impacting all retailers, with Michael Hill and Kathmandu warning consumers are starting to spend less. So how will the Warehouse work its way out of this one? Its Chief Executive Nick Grayston is here to talk us through his profit recovery plan. Hey Nick, nice to see you.
See you.
It's pretty tough out there. Would you call this a retail recession?
Yeah, for sure. And it's clear that our customers have had a tough year, and we've had a tough year alongside them. This recession has been looming for some time. What's very interesting about it is in the last year, we've seen coming out of COVID, a significant change in how people have used disposable income. When they've been locked up for 3 years, people have improved their homes. They've had to concentrate on work from home, homeschooling. People have done up their kitchens, for example, which drove things like appliance sales. But let out into the world again, people have spent money on restaurants and travel. And so, that disposable income change has particularly hit things like TVs and refrigerators and high ticket items. It's similarly, our Torpedo7 business, 37% of our sales are on bikes. And over COVID, because it was all that people could do, people bought a lot of bikes and, suddenly everyone's got a bike in the garage and that business has been tough. That's a global phenomenon.
I do want to talk to you about margins and how that's impacting brands like Torpedo7 specifically. But just first off, I guess the benefit actually out of this cost of living crisis is that you are seeing demand increase, particularly at your warehouse red sheds. Can you talk me through that top line demand? Just how much foot traffic and volume are you seeing come through, particularly on the cheaper products that you sell?
Yeah, so we're very pleased with what are record sales in the warehouse. And, coming out of COVID, especially in the first half, foot traffic was up 14% over the year. But it does indicate also that that 9% increase in sales, people are more considered about their purchases. But within the warehouse, one of the things that has driven frequency and traffic is our, very passionate attempt to offer Kiwi families affordable groceries. And so that's now nearly 20% of our business. And so within that, for example, pantry and chilled has grown 91.8%. We've worked very hard to grow our Market Kitchen own brand range, and we've now got 64 products in that. And we've done a lot to supply sort of some core essentials like butter at $4 for some of the year. We've now got our own Market Kitchen butter, which is really good at $5, and $20 coffee bean big bag. And we've had a great response from customers, and so that's really helped.
How much are your margins hurting on those lower value products, and how much less of a margin do you make on those compared to things like bikes at Torpedo7?
Yeah, for sure. The grocery margins are dramatically less than other things, and we have to unlike the duopoly, which is sort of keeping margins high across grocery and higher than they are in the developed world. We have a struggle to get access to affordable prices and wholesale supply, and as you know, it's been a big drive of the government with the Groceries Act and the appointment of a grocery commissioner. We don't think that's actually helped, and so far we haven't gotten equitable access to fair prices through that wholesale regime. And in fact, we think that it's helped the duopoly because they're able to pick up more volume discounts from the wholesale regime, and it's also helped a lot of the big suppliers as well.
Across your whole group business, though, margins are getting crushed almost everywhere, especially at the likes of Torpedo7. What's your plan to recover those? And can you
Yes.
in this environment?
Yeah, so in Torpedo 7, there's a number of different issues, and so firstly, there's a bunch of margin issues. So changing the product mix, for example, to higher margin categories like outdoor clothing, for example, and footwear, as opposed to certain lower margin things like bike parts and things that are in demand. There's also a whole bunch of cost control issues. We went through this year and are putting the final touches into our enterprise planning system. But equally, we've now moved the Torpedo 7 business into our agile operating unit within our central office. So we've taken out costs there. And we're looking at other product categories that we might get into.
I'm keen to understand your game plan on how to recover that. Do you go all in on volume and just try to sell more products to consumers in a cost of living crisis? Or is there any way that you can actually try to increase value across your group at all?
No, it's a little bit more nuanced than that, and that's what it's not a one size fits all answer. And with regards to margins, there are essential items that Kiwis need, and we worked hard to take the prices down wherever possible on those. And so for example, and especially delivering through our Market Club membership program, which is free to join. You can a $6 towel you can get for $4.50 as a Market Club member, and so that provides extreme value. As I mentioned, some of the grocery items, but we've got to balance that across the whole assortment and look at how we manage the product mix. We need to be much more efficient, and so we made the regretful decision to eliminate 320 roles back in April in our corporate office. That has a $24 million cost benefit. But that's indicative of the fact that it is a tough environment out there, and we need to manage it for the benefit of all of our stakeholders, our shareholders and our customers as well. And so it's not a one size fits all answer.
Can we expect any more cost out efficiency after this result?
Yeah, we're working on a whole bunch of things, especially around supply chain efficiencies. So there was a lot of disruption that went into this year. A lot of irregularity, China being shut for large periods of time, delays at the ports of Auckland and all the rest of it. That added a lot of cost, both in terms of detention charges on containers, additional costs to get it through our distribution center. We still had in this financial year the need to separate working shifts to manage the COVID issue. And that obviously drives cost as well. So things that like cross-docking and putting bulk stacks of grocery in our stores do enable us to be able to help manage those costs as well without having an impact on customers.
I do want to ask you about costs more broadly as well. Your top line, 3.4 bill in sales, record 1.9 bill sales at the warehouse. So on the surface, the sales look pretty good, but you're only profiting about 30 million out of that 3.4 billion. Talk me through exactly the increased costs that are eating away almost all of your revenue at the moment.
Yeah, so going into the last financial year, we had a plan for peak spending. You got to remember, coming out of a bounce back from COVID, 2 record years of earnings, we made the decision to speed up some of our infrastructure investments. And as you may know, we've been underinvested for decades in terms of core systems, and we've acquired different businesses like the Torpedo 7 Group, Nolimi, and all the rest of it. And so, have had to invest in those core infrastructural systems so that we can drive efficiencies going forward. We're about 3/4 of the way through some of those foundational things. But there's been a few things that have happened. There's been a change in accounting policy that means that stuff that we would have previously depreciated over 5 to 10 years got depreciated immediately. And in addition, have had a lot of software as a service has had to be categorized as operating expense. And so that's driven a lot of the cost base. As you'll have seen from our release, we have reduced that spending from about 154 million to 80 million for this current financial year, and so that's going to help us manage our costs a lot better. And so, we're not dependent on an improved consumer confidence to be able to drive a better outcome. And that's why it's been important to manage costs, manage margins, and frankly, we've had to delay some of those investments. And it's no different from Kiwi customers who can't do all the things that they want because they're under financial pressure.
One inflated cost that I wanted to bring up, and looking at the sort of details of your annual report, interest. The interest on your borrowings has gone from $740,000 last financial year to this financial year just ended up to $9 million. That, on my numbers, is a 1,125% increase. How are you managing that?
Yeah, and so as you'll have noted from the half year, we surprised the market with the increase in the decrease in working capital, increase in debt. And so that's been one of the major initiatives that we've worked through in the course of this financial year in terms of reducing our inventory, particularly, which has been a massive reduction. We closed the year at 493 million against 562 million at the end of the previous year. But that was up at 618 million by the end of H1. So our liquidity position has improved immeasurably. We're down to we're at 422 million liquidity against last year's 379, and so that's an 11% increase, or 43 million more of liquidity. And so that in turn will flow through to less debt equals less less debt that you pay interest on, but as you know, interest rates have gone up, and so more work to be done. We'll continue to manage our working capital and continue to strive to reduce our debt. And part of the reduction in capital spending is to do with that as well.
Okay, so cost control very clearly a focus for you, it seems, Nick. But Christmas is coming. What's your outlook for Christmas spending? Do you expect it to improve the business at all?
Well, as a retailer, you're always optimistic, and there's always the hope that current caution around spending coming up to an election, which is a typical pattern, will be followed by a more optimism and a bit more certainty about what the next 3 years will hold. And so there is an opportunity that sort of doesn't happen every year for people to want to open their wallets, but. The key message I give you is that we're not dependent on there suddenly being a sort of spirit of optimism and everyone goes out and spends. The other thing that we've endured for the last few years is poor summer weather, and it's one of the realities that the confluence of Christmas and summer in the southern hemisphere is a sort of double whammy for retail. And if it's a good one, then it's really good, and if it's a bad one, it's really bad. And that's something that northern hemisphere retailers don't have to contend with. So optimistic, but we don't bank on the weather. Optimistic on confidence, but we don't bank on that. And that's why we're managing our costs and our margins to make sure that we're not dependent on that to have a better outcome.
I've just got 2 more questions for you. And firstly, I just want to add another C into the mix. So you've got costs, Christmas coming up. What about crime? What are your thoughts on crime at the moment?
Retail crime has been a major issue. We've spent 15 million in terms of impact to our P&L over the last 2 years. We've had to strengthen a lot of our stores to protect our people and our assets. And the number of burglaries and ram raids that our people have had to endure are frightening. And so our focus has been on protecting them and making sure that they're properly trained how to deal with incidents. And we're thankful that so far, and it's more by good luck than anything else, and hopefully the precautions that we put in place, no one has been seriously hurt in our stores, though as you've seen, other stores have had to put up with that, and frankly people should not have to put up with that, coming to work to do their daily job. And so we remain vigilant and concerned about our team.
Have you taken any efforts to talk with police, to talk with government at all? I mean, I'm always kind of surprised by how clear of an issue this is for business, but it seems like no one's been that strong publicly about it.
So, I mean, yes, we have met with government. We've met with the police commissioner. The Police National Retail Crime Unit that was set up a few months ago, nearly a year ago now, run by Matt Tierney. We have a monthly meeting with them, and we found them very good and very engaged. But the problem goes beyond what that unit can do. But so we've been also very involved in things like the Retail Federation It's still a big source of concern.
One last thing I wanted to ask you about was your dividend policy. It's to pay 70% of profit out to shareholders. This financial year, you've paid 74%. It's cutting it pretty close. Should we expect the Warehouse Group to potentially change that policy, or will you always promise to stay above 70%?
Well, our current policy is to pay out 70% or more of our adjusted net profit. And so, we've done that. We've been able to do that because of the actions that we've taken. And the market should take it as an optimism about the year ahead. And, so it's within policy. No intent to change the policy at this stage, but, we will continue to look at it. We look at that all the time. And, it's a signal that we feel positive about the year ahead, despite all the headwinds.
Well, best of luck with it. Thank you so much for your time, Nick. Nice to chat.
Thank you very much. Great to talk to you.
And just a note that clothing retailer Hallenstein Glassons Holdings reveals its annual result today, marking the last of the retail results this season. But I want to know if you touch retail stocks. Do you think there's value to be had in them, given they're low priced right now, or are you avoiding them? Now go put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.